Every war has a price tag. What nobody tells you is who actually pays it. Think about what you have been told. That wars are funded by the nation, by collective sacrifice, by a shared burden distributed fairly across a society that agreed, or was asked, to bear it. The imagery embedded in that story is powerful and persistent. Liberty Bond posters on the walls of barbershops, ration books on kitchen tables, a generation pulling together because the cost was understood to be real, and the sacrifice was understood to be universal. That story is, at best, incomplete. At worst, it is the most expensive myth in modern history. Because the reality of how wars are actually financed, the arithmetic beneath the patriotic framing, the mechanisms that governments have used for 3 centuries to fund conflict without presenting the population with a direct invoice, tells a different story entirely. One where the cost is not shared equally. One where the bill does not go to the people closest to the decision. One where the financial system itself becomes the instrument through which sacrifice is distributed, quietly, gradually, and with extraordinary precision, downward. This is not a cynical argument. It is a structural one. And once you understand the structure, you will never read a defense budget the same way again. Welcome to Hidden Ledger, where we open the books that were never meant to be public. If you want to understand the real mechanics of money before the next crisis makes them impossible to ignore, subscribe now and turn on notifications. Every video we publish is another page of the ledger, the hidden one. There was a time when war hurt immediately and visibly. In medieval Europe, if a king wanted to put an army in the field, the options were brutally simple. Tax the population now, seize assets directly, or debase the coinage, shave the silver content of the currency, and hope nobody noticed fast enough to resist. Each of these methods shared one characteristic that modern governments have spent 3 centuries engineering their way out of. The cost was immediate, the extraction was visible, and visible extraction creates resistance. The 100 Years' War between England and France, which consumed the continent from 1337 to 1453, required repeated direct taxation of populations already stretched to the limit. Merchants, clergy, landowners, anyone with something extractable had it extracted. The fiscal pressure destabilized entire regions. Revolts were not exceptions to the system. They were a predictable response to a system that could not hide what it was taking. Spain, under Charles V and Philip II in the 16th century, learned the same lesson through sovereign default, declaring bankruptcy in 1557, 1575, and 1596 as endless military campaigns across Europe and the Americas overwhelmed revenues that not even the silver of the New World could replenish. War was expensive and the cost arrived quickly, and when it did, it was catastrophic. Then, in 1694, something changed that would alter the relationship between war and money permanently. The Bank of England was founded not merely as a financial institution, but as a structural innovation. For the first time, a government could borrow at scale from private lenders, issuing bonds backed by the authority to tax future generations. The cost of war could now be spread forward in time, rather than extracted immediately from the present. Britain fought the War of the Spanish Succession, the 7 Years' War, and eventually the Napoleonic Wars, not by breaking its population through immediate confiscation, but by borrowing against the future. By 1815, Britain's debt-to-GDP ratio had exceeded 200%. And the key insight is not the size of that number. It is what it represents. War had become financeable. The government no longer needed to break the population instantly to fight. It could defer the reckoning by decades. Once governments understood that wars could be funded through debt rather than immediate taxation, there was no returning to the old model. The invisible invoice had been invented. The modern financing of war operates through 3 interlocking mechanisms. Understanding each one is the difference between reading a headline and understanding what is actually happening to your money. The first mechanism is debt. When a government goes to war, it issues bonds, promises to repay with interest purchased by banks, pension funds, insurance companies, and foreign governments. The American Civil War accelerated this model dramatically. The Union issued war bonds and greenbacks, paper currency not backed by gold, and inflation followed as predictably as night follows day. World War I scaled it globally. World War II pushed American federal debt from roughly 40% of GDP in 1941 to over 120% by 1946, a wartime explosion of leverage that would have been unimaginable to a medieval monarch. Debt spreads the cost of war forward in time, distributing it across generations that had no vote in the original decision. The second mechanism is inflation. When governments cannot borrow cheaply enough and cannot raise sufficient taxes, they expand the money supply. They print, and printing reduces the purchasing power of every unit of currency already in circulation. It is taxation without legislation. There is no invoice, no line item on a paycheck, no moment of visible extraction, but it is extraction. In Germany in 1923, the consequences of financing World War I through monetary expansion rather than taxation arrived in their most extreme form. Hyperinflation wiped out the savings of the German middle class within months. The mark collapsed. Life savings evaporated. The social fabric tore. This is inflation not as a side effect of war, but as its primary payment mechanism. The cost of conflict transferred into the purchasing power of everyone who holds the currency. The third mechanism is financial repression, and it is the quietest of the three. After World War II, the United States carried federal debt above 120% of GDP. It did not repay that debt through dramatic taxation. Instead, interest rates were kept artificially below the rate of inflation for extended periods. If inflation runs at 4% and your government bond yields 2%, you are losing purchasing power every year, slowly, invisibly, without a single legislative vote. The government repays its debt in dollars that are worth less than the dollars it borrowed. Savers lose, debtors benefit. And governments are the largest debtors of all. Financial repression smooths the cost of war over decades, so gradually that most people never connect the erosion of their savings to the wars financed a generation before. Now follow the money more precisely, because the distribution of this cost is not random, and the pattern of who absorbs it and who escapes it is one of the most important and least discussed dynamics in modern economic history. When war spending ramps up, governments issue contracts. Those contracts flow into specific industries: defense manufacturing, logistics, energy, technology. The companies positioned inside that supply chain receive revenue before the inflationary effects of the spending reach the broader economy. This is the Cantillon effect in its most visible military form. Those closest to the source of new government money capture its value at full purchasing power, before the expansion of the money supply has diluted prices throughout the system. By the time inflation arrives on the shelves of an ordinary grocery store, the defense contractor has already converted government spending into profit, into capital, into assets that will appreciate in the very inflationary environment that their contracts helped create. During World War II, American industrial firms, Boeing, General Motors, Lockheed, transitioned into wartime production and received enormous government contracts as the federal debt ballooned. In the post-2001 wars in Afghanistan and Iraq, companies embedded in the defense ecosystem, Halliburton, Lockheed Martin, Raytheon, received trillions in expenditure while federal debt doubled between 2001 and 2008. Shareholders in those companies did not experience war as a financial drain. They experienced it as revenue. Contrast that with what war financing does to the person holding wages and cash savings. Wages lag inflation. They always have. If prices rise 6% and your salary rises 2%, you have absorbed 4% of that gap through reduced purchasing power. A transfer you never agreed to, through a mechanism you were never shown. The person holding cash savings in Weimar Germany in 1923 was ruined. The person holding real property, foreign assets, or equity in productive companies survived. The mechanism cannot produce equality. Its structure prevents it. There's a further dimension that rarely enters the conversation. In 1971, Richard Nixon closed the gold window, ending the Bretton Woods system that had tied the dollar to gold at $35 per ounce since 1944. The stated reason was economic pressure. The unstated arithmetic was the Vietnam War. By the late 1960s, the United States was financing simultaneous military escalation in Southeast Asia and domestic Great Society, spending programs without raising sufficient taxes to cover either. The resulting fiscal pressure, combined with foreign governments converting their dollar reserves into gold at a rate that was draining American reserves, forced the decision. When Nixon severed the dollar from gold, he removed the last structural constraint on debt-financed war. From 1971 onward, the capacity to borrow was limited only by the market's willingness to lend and the central bank's willingness to accommodate. The inflation of the 1970s, which eroded the savings of an entire generation of American middle-class households, was not random. It was the delayed invoice of a war financed without raising taxes, arriving through the mechanism of a currency set free from any physical anchor. Modern wars feel cheaper because the cost is abstracted. There are no emergency war taxes stamped across your paycheck, no ration books, no visible sacrifice demanded from the neighborhoods that cheer the loudest when conflict begins. Instead, deficits widen, central bank balance sheets expand, treasury auctions grow larger. The The United States entered Afghanistan and Iraq without raising broad-based taxes to fund them. Federal debt doubled in 7 years. The wars in those countries cost an estimated $8 trillion over 2 decades, financed entirely on credit, deferred to a future that is now the present. That credit card still has a statement date. The interest on accumulated federal debt has become one of the largest line items in the American budget, exceeding defense spending itself in recent projections, consuming dollars that cannot simultaneously fund infrastructure, healthcare, or education. When interest rates rose sharply in 2022 and 2023 to combat the inflation that had been building through years of monetary accommodation, the cost of servicing that accumulated debt increased dramatically. The fiscal flexibility that debt-financed war had appeared to provide turned out to be borrowed time, in the most literal sense. And the population that absorbed the visible end of that process, in the form of the inflation surge of 2021 through 2023, in grocery bills and rent and energy costs rising faster than wages, did not experience it as a war cost. They experienced it as a supply chain problem, a pandemic disruption, a series of misfortunes. The framing obscured the structure, but beneath the official explanations was the same arithmetic that has operated since the Bank of England issued its first bonds in 1694. When governments spend aggressively and finance it through debt monetized by central banks, purchasing power shifts. And it shifts away from those who hold currency and toward those who hold assets. The final lesson of this history is not comfortable, but it is simple. Wars are almost never paid for by the people who declare them or the institutions that profit from them. They are paid for by currency holders, by wage earners, by savers who trusted that the money they accumulated would hold its value, by everyone downstream from the mechanism of financing, in the years and decades after the conflict has ended and the headlines have moved on. The invoice arrives quietly. It arrives through slightly higher prices, slightly weaker purchasing power, slightly larger debt burdens on the next generation. The sacrifice is diffused across time and across the population in inverse proportion to the financial sophistication of the people bearing it. Understanding this is not about cynicism. It is the prerequisite for any honest conversation about financial resilience. When you understand how wars are funded, you understand why asset ownership matters, why holding only cash in an inflationary environment is a form of risk rather than safety, why the financial decisions of governments you may never have voted for will arrive in your cost of living, whether you follow the news or not. War is loud. The payment system behind it is silent. And in finance, it is always the silent mechanisms that shape your future. If this opened a door you didn't know was there, if you want to understand the hidden mechanics of your money before the next crisis makes them impossible to ignore, subscribe to Hidden Ledger. History is the only map we have. The question is whether you read it before you need it or after.